It is actually not a separate entity. Unfortunately, it's not a separate entity. It's just because it's already established corporation. It's just expanding its name, brand, and company. All right. So here we left off of the 5 business organizations. So now we're going to be diving into business activities. Okay. So again, there are 3 types of business activities. Number 1 is service. Okay. So I would say a good portion of the businesses out there are primarily service. So anything that sells a type of an idea or a service to individuals. So for example, the telephone service, right? It's a service. And they offer packages, they offer cell phones and stuff, but they actually are geared towards service. They provide something for you that consumers need, such as, phone, internet, and I believe they offer cable nowadays. They have a bundle package now. But for most cases, a lot of that is geared towards a specific type of service. So, most service companies such as like hotels. Hotels are all about hospitality and service. So, there's a lot of ways you want to package a specific idea or service. It does come to play where you may need to develop a service that people actually need, people actually want. So we have examples such as lawyers, accountants, cable companies. Yeah, all of those people are service, right? Usually they charge by hour, or they charge by how long the caseload is, or how deeply entailed this, like how long can they measure in time is it going to take to complete this task. So generally, those are service-based companies. Second one is going to be the most popular and well-known types of businesses, which is merchandising company, also known as retailing. So there are 2 different types of merchandising, which is retails, which is stores that sells goods to individuals, to the public, right? So if it's, for example, grocery stores, clothing stores, shoe stores, any store that actually sells a product will fall under the category of merchandising. Now, you can also be a wholesaler where you sell goods in large quantities or in bulk. Usually, it's generally the cost of selling an item in large quantities is a lot cheaper, but it can also be very costly as well. So, for example, Costco, Winco, Smart and Final, anything that sells items in a bundle or items the same product but in larger quantities. Usually they're wholesalers, and they sell to the retail stores as well as sell to the public as well. So that's why Costco is probably the most popular, widely known wholesale retail stores out there, because they do sell to smaller businesses, but they also sell to consumers on an individual basis. And then lastly, manufacturing companies. Okay, so this is where they make products out of raw materials. So in the United States, as what I'm aware of or what I know of, there's actually not many manufacturing companies located in the United States. I know that maybe GM Motors is like one of the bigger manufacturing facilities here in the United States. Reason being is because, it costs money to import raw materials. You need a big warehouse or facility to be able to produce those kind of products, and you need to have a a large area in order to build your own product. But again, it's actually really cool because you get to produce an item out of raw materials, and you have two choices. You can either sell it to a wholesaler and or a retail store, or you could actually sell it directly to a consumer. With the internet these days, you can sell anything to a consumer, either straight from the manufacturer or from any local retail store. Okay, so an example would be a car dealership. Well, actually, not a car dealership because they don't make cars there. They just sell cars, but a car manufacturing, such as GM, right? They produce the cars here in America, and they ship it out to the dealers to sell to the public. So I guess car dealerships are both manufacturing and wholesale / retail at the same time. But yes, those are the three core main business activities that you would commonly see. Most common one would be merchandising, because we love to sell products. Okay. All right, now we're going to dive into the fun stuff. So what is accounting? All right, accounting is a systematic process of analyzing, recording, summarizing, reporting, reviewing, and interpreting any kind of financial information or data. So the most common type of source, we call them, or a financial information, would be anything that has to do with a transaction, right? So it also answers the purpose that we review these kind of information is we want to answer the four questions. What happened? When did it happen? Why did it happen? And how did it happen? So for example, I bought something from the store. Well, what happened? I bought something. When did it happen? Yesterday or today. Why? Because I needed to buy groceries. How did that happen? I paid with cash. So just with one transaction, in order to fully understand why you need a transaction, why do you need to record or analyze a transaction, is to answer those questions right here, right? And that is the purpose of accounting, and this is exactly what bookkeepers do. They take a piece of financial information and they analyze it, and they kind of determine how and why do we record it. And the fundamental line behind it is, how does it affect my company, and is it significant enough to record? Is it something I need to record? All right? And that's the whole purpose of understanding and learning this entire class, is to understand why we need to record these things. And I believe in chapter 3, we will be looking at the 7 steps of transaction analysis, is what's called, and it's going to be a step-by-step process of receiving or collecting this source data, and we're going to analyze it and determine, and how we determine where to organize this piece of information, and whether it's worthy or not worthy enough, whether it's necessary to record the transaction. All right, and then financial information is used to measure the economic activity of a business. So economic activity meaning whether does it make a profit? Is it going to make me a loss? Okay, so what these financial information actually does is it helps explain why there's an economic trend, why there's a boom, why is there a fault. So again, this is also tied into economics, understanding the flow of demand and supply, understanding that flow. And what we gear towards our financial information is primarily for our internal users, so people within the company, and our external users, people who are outside the company. It could be potential investors, potential bank representatives, right? They might see that with this information that you provide us, okay, wow, this is good evidence that your business is doing good and that I can approve you for a bank loan. So it does a lot when piecing these kind of information together, especially if you do it accurately and correctly. All right. So the bookkeeper versus the accountant. What is the big difference? Well, I'll tell you in bold right now. The bookkeeper, all their responsibility to do is just record. The accountant does everything else. Okay? That's it. That's the very fine line difference between them. However, what the bookkeeper does, it is the act of recording and classifying business financial transactions. So solemnly, they are responsible to hold on to what's called the general journal. Okay? They are the one that's going to record every single detail. Now again, when we move into chapter 3, we're going to determine, is this transaction even necessary? Does it affect my business in any terms? Is there a dollar for dollar transaction when I am recording this piece of information? So the bookkeeper, all their job is to just record the transaction. They do a lot of thinking, okay? But not as much thinking as the accountant does. What the accountant does is not only do they get to record the transactions as well, right? So they have a dual purpose. When it comes, they can do the bookkeeper's job, but the bookkeeper cannot do the accountant's job. But however, the accountants, what's different is they are responsible to create the financial statements. They're the ones that tell the bookkeeper what to do in regards to creating the chart of accounts, which we'll talk about further on. They create the chart of accounts. They're the ones that sets the rules up for the bookkeeper to follow. They are also the ones responsible for creating the financial statements, closing the books out, etc., etc. They run the show. All right? The bookkeeper is just the actor. The bookkeeper is given a script, given all the source documents. The accountant is going to tell the bookkeeper how and what to record and how they want it recorded, okay? So the bookkeeper is essentially the executive supervisor, while the bookkeeper is just the employee, all right? So again, the bookkeeper, the accountant can do the bookkeeper's job, but the bookkeeper cannot do the accountant's job, all right? So that's the fine difference is bookkeeper only has one responsibility. Accountant has a lot of responsibilities, okay? All right, what are the different types of accounting? So this is where we can finally get to see the versatility of accounting, okay? Now, a lot of people, when they come into accounting, they think accounting is general. Oh, no, it's not. Accounting can be split into 5 different areas, and each area determines multiple things that you can do for accounting. So you think accounting is just one thing? No, it could be divided into even 10 different things, depending on which area that you're falling into. So number 1 is going to be public accounting. So this is where the CPAs are going to be located in. Private accounting will be for more smaller business, private, more private companies, not public figures or corporations. And then we have government accounting, right? For those who are I'll explain each one after this. But government accounting, yes, they have different rules and different guidelines. Of course, I did mention nonprofit accounting, right? Because their goal is not to make money, so they need to be taxed a certain way. And then lastly, international accounting. So we'll talk about the difference between the US, us accounting, and everywhere else accounting. Okay, so first we're going to talk about public accounting, which is known as, this is where the CPAs go to, right? This is for accounting for major businesses, public accounting, aka that's what a CPA is. It's certified public accountant. So they're more for the corporation, okay? And what kind of fields that you could go into if you plan to do public accounting is you have auditing, taxing, and you have forensic accounting. All right. Now, auditing, right? It's pretty straightforward. It's making sure that the company or the corporation, right, to make sure that they're doing their books good, right? Auditing, making sure that they follow the rules, making sure that everything that you're doing is protected, but also as well as goes in line with the U.S. GAAP. All right, so they analyze how well they follow the rules of GAAP. All right, so this is more for auditing, is looking through a whole year's of work, right? You're looking into the past and seeing if they made any mistakes. Did they do something right? Did they do something wrong? So that's what auditing is, okay? And that's what I wanted to do, but I didn't take, all right? Taxation. Now, most of you are tax accountants, so you guys are more educated in this than I am. All I know is you're dealing with tax, whether it's a public company, personal company, or personal taxes, or even public taxes on a grander scale, right? Are they paying their employees federal income? I forgot what the I stands for, but Contribution Act, right? Are they paying their duties to the government, right? That's primarily what tax accountants do. Yes. And like I said, I'm not too well knowledge in that. I only took one class, and I can tell you I did not enjoy it. However, again, if you're the kind of person that really enjoys trying to save people some money, that's also one thing too. Because I know tax accountants, there are a lot of rules that the general public don't actually really know when it comes to filing for taxes, like what kind of write-offs they can take, what kind of taxes they need to pay in to prevent them from having to pay more taxes. So that is that area there. And then lastly, forensic accounting. Okay, so I've actually taken forensic accounting in I believe my last year in college. So that was pretty recent, back in 2017. So I actually enjoyed forensics accounting. And the interesting about forensic accounting is it pretty much acts as if you are the investigator. All right. So Mr. Sanchez has mentioned earlier about that Enron movie. And yes, we had to use Enron as our investigation case study in class because, they have that terminology, where you cook the books, you try to make clean copies. And then so you have the copy, the frauded copy, and you have the regular copy. So what forensics accounting does is investigates for potential fraud. And it's a really interesting class to see what actual real people actually, they even still do today. And we don't know because it's right under our noses. You have to be a mastermind you have to think like a mastermind in order to try to fraud the company without getting caught. And believe it or not, the major corporations here today, they still do it, and we just don't know. And they just cover up very well. And and this is where ethics comes into play as well, because if you do the right thing, which is to be a whistleblower, right? Tell the public that this corporation is doing something wrong. The corporation's going to destroy you. They're going to fire you. They're going to do a lot of things to you. Okay? Because the corporation has that power. Now, that's why you have to be very careful when you're doing forensic accounting, is because you may think you just by looking at their financial statements, nothing looks abnormal. Then you can also say, but little do you know, if you really go in detail of every single thing, actually do a full-on investigation, you'll realize that every corporation frauds at one point. And that's the really interesting thing about that. So next, moving on, is going to be private accounting. So this is where the broader aspect or more multiple hats can be expanded, especially when you're doing private accounting. So here we also have a tax accounting on a smaller level. Okay, this is for more smaller companies that need to help file in their taxes for being a small business. We also have auditing at a smaller scale for those smaller companies. And then we have financial accounting. So this is what this class is. This class is focused on primarily understanding the fundamentals, but understanding how to properly record for our auditors to, not have us get fined, right? But also financial accounting also helps out our tax accounting, because if our stuff is organized, it makes the tax accountant's lives a lot easier to pull out the information that they need. Okay, and then other than that, there's managerial accounting. So this is definitely more applied towards cost. I'm sorry, not cost. The managerial accounting is applied more towards manufacturing. Reason being is because it breaks down costing, cost accounting, right? It's understanding how to create a product by using, how to produce an item with less cost, right? In order to make a bigger profit. And under there is going to be budgetary accounting, so learning how to work with a budget, and green accounting, so how to make the stuff that you produce eco-friendly. Those usually all fall under either some type of manufacturing, but it can apply for a regular business as well. Especially if you're a service type of company, right? How do you provide a service that uses the less cost, or cost accounting can apply for many things, as far as it doesn't have to be manufacturing per se, but it does help for that purpose. And then we have treasury accounting. So again, that's dealing with banking types of accounting. And then lastly, we have financial planning and analysis accounting. So that's more towards when you reinvest onto your company, and things like that. So for planning for the future of your company. So these are the aspects that you can find when you're going into private accounting. So you have more flexibility, more versatility to become a private accountant versus a public accountant. All right, other ones is going to be government accounting. So this is primarily geared towards federal agencies. So, for example, you guys, if you guys have heard of or come from the One Stop, they are a federal government agency. So, again, they require people to get taxed. So, right now, I believe it is, they're wrapping up their fiscal year. So, July should have been the last time they can start supplying the money before they renew their year. So they need people to be able to do the accounting for that, to see how well they spent their money, or what areas do they need to do with their money. Okay. And again, they could do resource management accounting, and then lastly, agency fund management. So that's what I was talking about, is the agency fund management. Like, since most of these federal government agencies, they are funded by the government, so they need to have some kind of budgetary resource accountant to be able to do the accounting there. All right. Next is going to be nonprofit accounting. So again, for those who are nonprofit organizations that are just geared towards to just spread awareness and to educate, they have a different set of rules and guidelines on how they are taxed, as well as how they are being accounted for. So again, primarily because they don't receive money based on selling items, they need a budgetary accountant. So being able to create budgets and see what they can and what they can't do. So that's definitely the most important thing as far as the nonprofit organization. They also need a funds management accountant, so someone to either collect the funds from donations, whatever organization that they do. So they do need those type of accountants to be able to be properly run as a nonprofit organization. Oopsies. Lastly, but not least, is going to be international accounting. So, of course, many companies here in the United States do business abroad. So, with that being said, of course, we did mention about the IFRS, which is the International Finance. I forgot what R stands for, but the reporting, right? Yes, reporting standards. There you go. So because international has their own set of rules, they play by their own game, their own rules, right? We need a professional accountant to be able to do international accountings, because again, US GAAP only applies to businesses in the United States. If we do business overseas, we need someone to apply to learn those IFRSs, or whatever, depending on what country they do the business in and what guidelines and rules that their accounting is. They need to be able to learn that and do the proper accounting rules for the entity that they reside in or that they're doing the business in. Because, again, the U.S. only does U.S. And anywhere overseas, you must follow whatever rules that they do. So you need to have accountants that can be able to do that. Okay, so for example, they need to be able to manage foreign currency. Okay, that's very important. Right? So that's pretty much the gist of it. But for us, we're just primarily focusing on the private sector for this class, because we are doing just financials and we are starting from square one. So we're just doing the very basics. So again, so financial reports, okay? So we have a total of 4 financial reports. Now, these ones I just created little small snippets, but the most important statement that we provide is going to be our profit and loss, or also known as our income statement. Now, this is number one, especially when our main focus is primarily merchandise business activity, right? Our goal is to sell a product and gain a profit, and hopefully, so we're going to try to buy our materials at a very, very low price and mark up our price and sell it for a higher dollar amount so we can make a profit. So the income statement is by far the most important one, because it shows, does our company make a profit? Did we incur too many expenses along the way to cause us to have a loss? So it pretty much outlines all of your sales, and you're going to deduct the cost of material or deduct the cost of goods sold, and then you're going to also deduct any operating expenses that occurred in your company, such as rent expense, right? You need to make sure that your profits can cover all expenses, including rent, okay? So that is the goal of the income statement. The second income statement, or financial statement, is going to be the statement of owner's equity. Now, oftentimes you can actually pair this one up with your income statement. Balance sheet. I'm sorry. I was just realizing. Oftentimes this statement is paired up with your balance sheet. So, and we'll talk about the balance sheet in a minute. So what the statement of equity does is, this is where, after you've done your income statement, so it's important that you do these statements in order, all right? So if you notice, in the previous one, we noticed that we calculated a net income, all right? So that means this is our profit that we earned as of this period, okay? So what the statement of equity, owner's equity, does is it actually allows you to either or. One, if you plan to reinvest into your company, then your value of the company will increase. If you plan to take money away from it, which you can as a sole proprietor, you're able to take money out of your company and also take and invest money into your company. So this is just a way of determining whether you reinvest your profits into the company. And the purpose of this is, so what equity is actually, equity determines the value of your company. It's your original investment. It's what you hold as the value of your company. And whether you invest more money into it, which is a capital contribution, or if you take away money from it, which is called an owner's withdrawal, or if you place your profits, your net income profit into here, you would reevaluate your company. So in this case, because we had a positive number or an income, we didn't have a loss. We had an income. Therefore, our company has a higher value now. It began at 2,000. Now it's worth 2,300. Okay, I'm sorry. Yeah, 2,300. It started at 2,000. Now it's at 2,300. Okay. If you were to have a net loss, meaning you had too many expenditures throughout its period, unfortunately, you would have to take it out of the value of your company unless you pocket out your own money to pay for that loss. But in most cases, it often isn't. So you would have to reevaluate your company if you have a loss. Okay? So that's the whole purpose of creating the owner's equity. And when we move into the balance sheet, all right, as you can see, the balance sheet is going to focus on the accounting equation. And the accounting equation is all of your assets should equal all of your liabilities plus your equity. Okay, so again, assets equals liabilities and owner's equity plus owner's equity. All right, so that means your total amount that you own should equal the amount that you owe plus the value of your company as of that month. Okay, so and this is why most oftentimes you would calculate your owner's equity or your statement of owner's equity, and it's usually paired together with the balance sheet, because at the bottom of the account of the balance sheet you have an equity account, and usually, again, they're paired together. Okay, but yes, so the underlining rule of the balance sheet is you're going to apply it to the accounting equation. So all your assets must equal your liabilities and your equity. Last one that most companies kind of exclude is going to be your statement of cash flows. Reason being is because it can apply to you if you're using accrual basis, but if you're using cash basis, then this statement isn't as necessary. Reason being is because what the statement of cash flows really does is it actually determines how much actual physical cash is flowing into your company and how much is it actually going out of your company. So again, when we're dealing with accrual basis of accounting, which we'll talk about those in later chapters, accrual basis basically allows you as a company to either owe people or people owe you. So therefore, there's no physical cash that you're really receiving. It's an IOU in a sense, okay? So what that does is, what the statement of cash flows does is it takes those accrual accounts, such as accounts payable and accounts receivable, and it converts them into potential cash to let you know, well, if you were to receive all of your the money that people owe you, all your customers that owe you, this is typically how much money you actually would have in your company. Okay, but again, this is especially when you're doing with accrual basis, it's all theoretical. Reason being is because you can't guarantee all your customers are going to pay you back. And you yourself, too, is you can't guarantee you're going to pay all the people that you owe. So, again, that's what the statement of cash flows is. It's actually seeing how much actual cash is flowing into your company and how much actual cash is flowing out of your company. So, it's if we go into detail, we will be, by the end of this course, you will actually be piecing together each and every single financial statement that you see here in class. This is just an introduction to so you know what is gonna be what you're expected to see and what you will be doing in class. So you will be piecing together all 4 financial statements by the end of this class. Okay, but first off, we gotta start off by obviously with chapter 3, which is introducing you to how to actually record a transaction in order to create your financial statements. So last concept I think I have here is going to talk about internal controls. So what internal controls does is they are the people that not people. It's some kind of form of structure to prevent from fraud from happening, right? If you're a business, you definitely want to have internal controls, right? You definitely don't want to have one person in charge of payroll and accounts payable. You want to have them have separate jobs and separate duties, and that's what internal controls does, is you need to have some kind of structure to ensure the accuracy of accounting, especially with those rules being intact. It is very sensitive, and that is why a lot of the rules have changed, especially when it comes to accounting. You never want to have someone wear all the hats, because ultimately they can manipulate you and they can manipulate your company. And since they have the power to write a check, they can write a check to themselves, and they can ultimately ruin your company. So it's important that you have some kind of structure as far as in the organization, to ensure that this fraud doesn't happen. So oftentimes, an example would be if you're going to do payroll, right? You're going to have someone to calculate the payroll for you, but the president has to be the one to sign the checks. So that's 2 people that they need in order to sign a check, right? And then obviously the person who's working or who is an employee, if they are not designated as the payroll person, right? They can say, oh, I worked 80 hours this week, right? And obviously the president has to kind of look at it, or the owner, the CEO, whatever you want to call them, the most higher up, the one that signs the check. If they look at your paycheck, because you're the one who created the paycheck, and they said, why in the world am I paying you so much money? Did you really work 80 hours a week? Because you only work 5 days a week or 4 days a week, whatever you want to say. So that is one way to prevent fraud from happening, is you're having multiple people have to sign off or validate these transactions, okay? And all of this was because of Enron, all right? So the Sarbanes-Oxley Act, which is one of those rules that says that you need to have separation of duties when it comes to accounting. All right, and again, the Sarbanes-Oxley Act was placed because of Enron. Enron was doing so many things wrong. They were just a company that we trusted in. Little did they know, they partnered up with was it Arthur Anderson?
Yes.
Arthur Anderson. Okay, I always get his name wrong. They partnered up with Arthur Anderson to basically cook the books. So Arthur Anderson, he was not only the person who rewrote all the books for Enron, but he was also getting paid the big bucks, being part owner. So it's a what is it? It's a conflict of interest, they call it, because he was getting paid on the side, and he had to write off these things and cover up basically all the evidence. So he was getting double paid, and he was, and you have to record that payment. So things like that, so that's the reason why we have the Sarbanes-Oxley Act, which holds place to enforce the whole separations of duties, and to have internal controls placed in any type of business organization. So, on a side note, if you are the owner of the business, you make all the decisions for the transactions. Yes, you get to write the checks and whatnot. However, if you're the owner of the company, cannot be the one to do the books. You cannot be the one to be the accountant. You have to be just the owner. And that's because of this rule right here. Because honestly, if you're your own business and you get to have access to your own books, you can write a whole bunch of business expenses saying, oh, I buy coffee every day, I'm going to make that as a business expense. You can manipulate your own financial statements and pretty much buy yourself whatever you want. Be like, I'm going to buy a TV for myself. I'm going to say it's for my business, but I'm buying it for my own home. Things like that. So that's why the owner And the accountant cannot be one person if you're under a sole proprietor. Okay? And oopsies. Whoa, I think that is it for this one. Okay, there you go. So here's a little quick review of what we just learned today. So again, the nature of a business is ultimately to take natural resources, raw materials, and add labor to it to create a profit. To create a product, goods, or service and supply it to a customer. We have the 5 different types of business organizations here with a quick synopsis of each one. Mostly key points to pretty much determine what the difference between the 5 are. And then lastly here we talked about the 3 different types of business activities, okay? We talked about the difference between the bookkeeper and an accountant. We looked at the 4 financial statements and then the 5 areas of accounting. And then right here is the definition of what accounting is. So that is chapter 1 for you guys. Any questions in regards to chapter 1? It's a lot of information, but